If you own shares of Intel, this video should be a wake-up call. If you don't own shares of Intel, you can still learn from this video that when a company shows who they are, you should absolutely believe them. Hey guys, hope you're doing well out there. It's time to check in with shares of Intel Corporation that are tanking nearly 20%. That's right, nearly 20% in the after hours, despite the stock being down close to 42% year to date. We will get into exactly why this crash makes perfect sense for Intel. We'll get into their Q2 results, we'll get into the disastrous Q3 guide, and then when we take a look at this from a technical perspective, there's really simply no reason, there's absolutely no reason why you should come in here, pick up shares of Intel on this disastrous print that they just reported. Despite a booming semiconductor industry, despite a time where all of your mega cap tech are spending tens of billions of dollars investing in AI data center chips that these companies like an Intel provide, Intel Corporation simply cannot ride that AI wave, no matter how hard they try or how hard they tell you that they're riding that wave. Yeah, I'm here to tell you Intel simply is not on that curve, and they're going to be left behind just like they have been over the past really any length of time. Now, Q2 revenues came in at $12.83 billion. Not only was that a decline year over year by nearly 1%, that missed estimates on Wall Street by $150 million. So there's your first red flag. You came in with a top line miss at a time when the semiconductor industry is simply booming. You take a look at the stocks of AMD, take a look at the stocks of Nvidia, take a look at the revenues that these companies report, take a look at Broadcom, TSM, you go down the line. The semiconductor industry is absolutely booming at a time where Intel is reporting revenues being down 1%. On top of that, your non-GAAP EPS came in at 2 cents, again, missing estimates by nearly 8 cents. So you're basically hardly making any money on your revenues you're generating. So your margins are damn near at zero over at Intel, despite, again, the semiconductor industry being highly lucrative and in high demand at the current time. Now, on top of that disastrous Q2, what we got was a Q3 that looks even more troubling. Your Q3 revenue consensus was for nearly $14.39 billion. Intel is guiding for the upcoming quarter to come in between $12.5 up to $13.5 billion in top line revenue. So you missed your Q3 guide by nearly $1 billion on that top line. And then what's even more worrisome is the analysts on Wall Street were estimating Intel to earn 32 cents per share in the upcoming quarter. Intel is guiding they will lose 3 cents per share in the upcoming quarter. So not only will you not make money, in fact, you'll actually lose money by roughly 3 cents per share. So your margins are taking a hit, your revenues are taking a hit, despite all of your mega cap tech telling you that they're going to spend more in the upcoming quarters, in the upcoming years on their capex in order to build out their data centers. And in a time where AMD just told us that they're doing pretty well on the AI PC demand, yeah, Intel simply is falling behind, falling flat on their face, and this time that they're losing right now will certainly also catch up to them a couple of years down the road. And so since they're guiding by roughly $1 billion shy in the upcoming Q3, which was still would have been just flat growth year over year, now they're expecting declining revenues. Yeah, that Q4 revenue will probably come down Q1 in next year. And we basically get the story that the estimates over on Wall Street really have to be adjusted significantly. And then on top of that, your earnings actually should be declining this upcoming year. So despite having a fairly low valuation, especially when you compare to the other semiconductor names, yeah, that valuation will likely head higher simply because this company is burning. That's right, burning through a ton of cash and burning through a ton of money at a time when they simply should be making a lot of money. On top of that, this company announced that they're cutting back nearly 15% of their workforce as they look to streamline their operations. They're looking to cut back meaningfully in spending as well as in headcount at a time where all of the talent in Silicon Valley likely heading over to AMD and Broadcom. Intel simply will not be able to attract the talent that it needs in order to keep up with the other names in the space. On top of that, they're saying that they're going to cut back spending on new plants, new equipment by more than 20%. And so again, at a time when CapEx is really peaking, is really aggressively growing on a quarter over quarter, year over year basis, this company is pulling back on that spend that right now they simply need to in order to survive. But a couple of years down the road, they simply will not have the same semiconductor technology or the manufacturing capabilities that the other companies will have, say 2 to 3 years down the road. On top of that, the only other reason why you might consider holding shares of Intel is right now you get a small 1.6% forward yield, but guess what? They just announced that they're looking to suspend that starting in the fourth quarter in order to prioritize liquidity, which is basically another way of saying they don't go bankrupt. So Intel will again cut back on that dividend. So there's really, again, no other reason to continue to hold shares in this company that are down 42% year to date, again, down nearly 20% in the after hours. On top of that, the only really slide you should look at is this Intel Foundry slide. Really tells you where this company's head is, where management thinks is a good idea to burn money in at a time when, again, AI demand is going through the roof. This company is trying to be your next TSM at a time where it's simply extremely expensive to. And yeah, well, they're not doing a great job at it because they're losing nearly $3 billion a quarter trying to build out this foundry business that really I doubt a lot of other semiconductor names will use, with operating margins of negative 65% that have just continuously been trending in the wrong direction. So this company is a ways, and I mean a long, long way away before turning around this foundry business. I have a feeling in a couple years they'll come out and they'll say that, yeah, they simply should have never entered this business because the cash burn on that is probably something that this company just cannot handle at the current time. Now, we'll go over these financials, which look pretty bleak very fast, as you have net revenues coming in at $12.8 billion. That was a decline year over year. On top of that, your cost of sales also coming in roughly flat. So your gross margins actually going down to $4.5 billion. Last year, you were at $4.6 billion. On top of that, your operating expenses actually expanded. So with your gross margins declining by nearly $100 million, this company bolstered on an additional $1 billion operating expense. And that allowed their operating income to go from a loss of nearly $1 billion to now nearly a loss of $2 billion. So they're certainly not turning around in the right direction. In fact, they're heading in the complete wrong direction, increasing those operating losses on, frankly, lower gross margins. And we basically come down to the net income, and you're looking at a net loss of $1.6 billion in the most recent quarter. Keep in mind, that is just going to accelerate as they're guiding for a net loss of 3 cents in the upcoming quarter. On top of that, you are actually getting dilution with this company because when we get to their balance sheet, yeah, they simply just don't have a ton of cash or a ton of cash flows. In terms of the balance sheet, you're looking at right around $30 billion in cash and short-term investments, while on the surface sounds like a good amount of cash for a $130 billion company. Keep in mind, they're sitting on nearly $5 billion in short-term debt and an additional $48 billion in long-term debt. So you have well in excess debt than you have cash on this balance sheet. Really gives this company no chance to compete against the likes of Nvidia, against the likes of AMD, when they're burning through nearly $3 billion on a foundry business every quarter, and they're sitting on nearly $50 billion in total debt. Yeah, this company is just not in a good financial position. Really, that balance sheet should tell you enough that this company has a long way to go before it should even be considered as a sustainable investment. From its cash flows, you have nearly a $2 billion net loss. This is for a 6-month basis. Again, look at the fact that over the last year, you've nearly doubled your net loss, despite, again, the semiconductor industry being absolutely on fire. On top of that, to make things worse, this company is handing out more stock-based compensation to their executives instead of less. So they're losing more money, they're burning more cash, they're taking on more debt, and they're rewarding their executives for doing that at a bigger pace. So again, another red flag. When the executives take home more money despite losing more money for the company, yeah, that's a clear sign you should absolutely stay away from companies like this. In terms of operating cash flows, $1 billion is all we have to show over the last 6 months for operating cash flows. And then look at this, $11.6 billion in capex spend, again, to build out that foundry business, losing nearly $3 billion a quarter at negative 65% operating margin. So this company spending the very little operating cash flows they do have and a whole lot of debt in order to build out something where they'll likely continue to lose money, I'd say at least for the next 2 to 3 years. In terms of the other things they're doing with that cash, basically just refinancing that debt because, well, they simply can't pay it out from their cash flows. Again, from a fundamentals, we talked about all the reasons why you should stay away from a stock like this. From a technical perspective, it gets no better as you're basically in free fall, coming down to $23 a share. You're breaking multi-year levels of support, coming back to the same levels you were trading back in 2012, coming back to the same levels you were trading back in 2003 and 2004. So again, from a technical perspective, this is absolutely a falling knife, one I would stay away from. There's no clear signs of support at these levels. They're also cutting that dividend. So really any value investors or dividend investors that were holding onto this stock due to that dividend will likely hit the exit button tomorrow. That was my take on shares of Intel, a clear sign of a company you should stay away from, one you've probably known to stay away from for a long time, but in case you hadn't, this is a company you can learn from on when they show who they are. You should absolutely believe them. And Intel, over the past year to date, over the past 1 year, 5 years, and 10 years, really has been showing who they are. And yeah, you should simply believe them and stay away from investing in a name like this. Let me know your thoughts on this one in the comment section below. As always, thanks so much for listening, and I'll catch you guys in the next video.